back for another one. There's certainly no shortage of information to talk about. The big question is it telling a story? Because I think everybody's looking at the data, and I feel really sorry for those people that are trying to predict the future with this data, because I think we're just seeing mixed messages, right? We're seeing on one hand, the economy seems to be doing super well. We get a jobs report number where, blew everybody out of the water. But then on the flip side, you hear from all the big tech sector, right? That purchases are down. Cardboard box sales are apparently down. So trying to infer, does that mean something that we're actually consuming fewer products? But then credit card companies come out and say that purchases are up there. So we got stuff all over the map here. And I know we're going to get into a little bit today, obviously the news headlines of all this stuff. And then how does it fit into our portfolios? And not surprising to anybody that listens to us, we're going to go back to financial structure, I'm sure. But yeah, I would love to just hear from you, Justin, when you start to hear all of this news information come out. It's not like we're totally flippant and just saying like, this is irrelevant. I mean, it's super interesting. There is implications to our portfolio. So maybe just kind of give it 2 cents, as you read these headlines. What goes through your head?
Well, I'm looking to see if anything tells us who's going to win the Super Bowl.
Yeah, there we go.
Trying to read between the tea leaves there. Don't have one yet. So come back later this week. Anyway, we're constantly reading about what's going on, conducting an analysis, if you will, as well, not necessarily to try and predict the future, but really the broad way to answer your question is the way in which we read and digest all this information is to say, hey, does this cause us to question the data, right? What the data says from the past, right? Because generally speaking, if you're looking at data, you're looking at the past, you're looking back into time, which is a incredibly good place to start. You can always glean a lot of information. You can learn a lot, and you can begin to ask some questions. Oh, hey, is there any reason why what has happened in the past should continue going forward? You're not necessarily using it to predict the future, but you're saying, hey, are there patterns here where we have some confidence in positioning ourselves based on this old data? And I think that's the way in which we start to analyze this stuff. Does it cause us to change our general approach to markets, to investing, when we're reassessing information? Hey, the Fed came out and raised interest rates a little bit more last week. Does that cause us to change our approach in any way, shape, or form? And I mean, the short answer for that is no, it doesn't. There isn't any predictable relationship between interest rates and increases in interest rates more specifically, and what the market may do as a result of that. There's been a defined trend in that over a shorter period of time, but is that going to continue? And the data says no, and we don't have any real strong conviction why that may or may not change. So hopefully that's not too in the weeds, but gives a sense. We're analyzing this information constantly, and we're saying, hey, does this make us change our general approach based on years and years and years of data, and what that data says and gives us confidence in?
Yeah, and I think that's a good point. And we're broadly speaking, at least right now, about the public markets too, right? Yeah. These big macro themes that were kind of popping up in the news and that we're studying, in the public markets, those things, our belief and what the evidence really shows, right, is that, as a broad market perspective, we're pricing those things in. And so, to try to figure out like, hey, is the market mispricing this stuff, is really difficult, as we know we've talked about in the past. But I think where it does bleed over, and maybe even macro doesn't make a big investing decision on the private market side, but it probably has more of an impact there. We know there's tons of inefficiencies on the private market side. So if it's true, right, that the cardboard sales piece and now Amazon's not shipping as much, maybe that doesn't affect a private company that we need to be a little bit more in tune to when we think through that type of stuff. Completely.
One thing I would say as well, though, is we're making all decisions very much with the long term in mind, even in the private markets. But to your point, maybe there is a private market fund or private market company that we're invested in where there is a little bit more guidance or hand holding that can happen there, whether it's via us directly with a relationship and a company, or via a venture fund, to just help provide that guidance to those startup those founders who are running these companies on a day-to-day basis to help them. Hey, do you turn left here or turn right here? Or do you make this higher? Do you not make that higher? There is more activity involved with that, but you also have to have that healthy skepticism around predicting the future. You can't make any, guaranteed bets. You need to stay flexible. And a great case in point is the IPO market right now potentially is loosening up a little bit. People were saying just 3 months ago that it's going to be dried up for many, many, many years. And so, yeah, it's better to be more conservative and cautious than aggressive, but it's just a perfect reminder that things change fast. We talked a lot about that last week, how fast markets move, both in the public and the private side of things. So a lot of it on the private is more, almost hand-to-hand combat, if you will, and really saying, hey, let's be adaptable, but let's make some changes here.
Yeah, totally. And I think when we kind of take a step back, and I think it's as good for all clients listening to go through the reminder of how we actually build the portfolio, right? The construction part of it. How do we figure out how much to put into public fixed income? How much do we put into public stocks or equity, right? That ownership side of your portfolio. And then ultimately, if you're in a position and you've accumulated enough wealth to really achieve, stability in your priorities, then how do we think about the private markets? And I think the one big message everybody hopefully knows by now is that it's really customized, so you may have a client listening that has earned, $50 million in their career. They've got a family, et cetera. They're going to have all their priorities built out. And then you have another client that earned $50 million, in their career and have their priorities, and have a family, but totally different priorities. Totally. And so the construction of the portfolio is going to be totally different. The first client, may have a, 10% allocation to venture capital, whereas the second client, maybe 5% because they have different priorities, have different needs in the short term. So I'd love to just hear you talk a little bit about, and we don't need to go into depth. We don't want to keep everybody on too long today, but how do you, when you have two clients that seemingly in world standards, most advisors would look at them and say, they're pretty similar. How do you think through the complexities of the differences?
So to your point, every single individual is unique and different, even if you have similar earning profiles, similar age, similar demographics. Everyone's different. I think that's a pretty acceptable statement, or we could call it even a fact. So that's a starting point, and that drives us to customize everything based on that statement. The way in which we do this is to basically categorize priorities in a way that gives us a timing need of those priorities, right? Is that next year, 2 years, 10 years down the road? And how flexible is that?
Right.
It could be I'd like it to be 2 years down the road, but it could be 4 if I need to, or no, it has to be 2 years, right? So there's a couple different characteristics that we slap onto these priorities, both time and importance, let's call it that. And then what we do is we basically start to match those priorities with an asset, with an investment that behaves in a very, very similar way, right? This is called asset liability matching. It's plain and simple like that. Now, there's a lot of complexity in it in how we actually assess what are the right investments to match things up. But the simple example I think we hit on quite a bit is for a short-term, very, very important priority, right? Sending a kid to school or buying a house at a specific point in time. You don't want to take risk with that, because when that time comes, there's a chance if you were taking risk that the value is less than you need it to be. And so we start to build on that concept, right? With these are building blocks in a sense, where priorities that are a little bit more flexible, longer term, we take risk with assets, with investment in matching those priorities. When I say take risk, we're putting them into stocks and equity. And then when you start to get out longer, or you're projected to have a legacy or excess resources at the end of your life expectancy, those type of numbers or those type of financial structure makeups then start to give us a lot of confidence in the private markets, where you're taking risk. You're also ideally increasing your expected return if everything goes according to plan. But those are also really long duration assets, right? You're in early stage venture capital. You're typically locking up money for 10 years plus or minus potentially. At least that's around the expectation you should have. And so those are all considerations that then are matched directly with someone's unique overall financial structure and priorities.
I think that's a great way to put it. And it is, right? Like as you build out this customized portfolio, our goal is to allocate you to the highest expected returns possible. And we're always going to do that within whatever sliver it is. Yep. But it also is within your control. If you want to be in the private markets more in a responsible way, it means maybe reevaluating some of the priorities you have on the front end, right? And if you don't require as much on that front end side, then we get to allocate more to the higher expected returns down the line. So certainly within your control and able to put it all together in a really effective way. And so I think at the end of the day, maybe to sum it up here is just, the reason why we want to be customized isn't just because it sounds good, right? What it ultimately does is leads to, a higher confidence in the actual outcomes, right? And if I'm investing money for myself, that's all that really matters. We talk about money as a tool. I mean, getting some high-end return in 1 year, but you're risking your entire financial structure is not something we're in the business of. So when we're working with clients as you're listening and building out your portfolio, that is why we spend so much time going through your priorities. That's why we want to understand what's important to you, is because we want to be, kind of the old saying, we want to be conservative where you need to be conservative, but then we want to be growth oriented where we can take that money and you get what you deserve. There's no sense. We just had, looked at a portfolio that unfortunately a new client, they didn't have an advisor that did this work for them. And so they were sitting there in these lower returning assets when they could have been allocated to higher returning or higher expected assets, right? And so the good news is they're young. We got lots of time. But this is why we go about building your portfolio in the way that we do. So we'll sign off for today, but I want to remind everybody of that phone number. We'd love for you guys to text us, and then that way you also get some updates. We got some exciting things coming that might be fun for you to get a text from this number. It's our phone number. It's my phone number. So 602-704-5574. We'd love to hear from you. And until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.